Hello, good morning. My name is Yemi Leguche. I'm a licensed financial security advisor, and the topic that I have today is what is called employer life insurance. Wow, because if you have employer life insurance, some actually think they don't need personal life insurance. So I'm here to actually educate you on why you need personal life insurance. Your employer life insurance is fantastic, very, very good. Okay, very good. Because group of people apply for life insurance, they are offered life insurance from their employer. So the cost is actually very, very low compared to you having your individual personal life insurance. But there are some things you need to know. Your employer life insurance was offered you because you work with that company, right? And it is usually based on your income. What is your income? Let's say your income with your employer is $80,000. That is what you earn. Your life insurance from that employer life insurance may just be $80,000, and that is it, or just two times your annual income, that is 160,000. That is usually the practice in the private sector. They will give you the value of your income, or the maximum is two times your income. What that means is this is you, your income is 80,000. For example, your employer gave you the maximum $160,000 life insurance. The question to you is $160,000 life insurance coverage, is it enough for your family? You have a beautiful partner, you have three kids, two kids. Is it enough? That means if life happens today, you gain admission to heaven, and they actually pay that $160,000 to your family members. Is it enough? How long will that money last? Maybe 1 year or 18 months, and then they are back to zero. That is what it means. Because the employer did not know that you bought a mortgage of $700,000. The employer did not know that you have a credit debt of $50,000. The employer did not know you bought another property you're using for real estate investment, you're using it for Airbnb. They don't know. So your life insurance should actually be able to support your family for the next 10 or 20 years. That is depending on how you love your family. So for example, you earn $80,000. Do you want your life insurance policy to be able to pay at least $800,000 or 1 million benefit tax free to your family? That is the most important thing you should consider. Life insurance in Canada is paid out to your family tax free. So now you are 30 years old, you are single. It is a good time to set up your life insurance because you're young, you are healthy. Now, you might think, oh, you don't have a family, you are not married, you don't have kids, you don't need life insurance. You are actually the one that needs to get life insurance. That is because you are young, you are healthy, right? So your cost of insurance is very low. So the question that I get asked is, when is the best time to get life insurance? See, so far you are alive and breathing, we are not guaranteed about tomorrow. So today is the best time to set up your life insurance policy, right? Another thing that comes to mind is, for your life insurance policy, the benefit goes to your family tax free. So you are 30 years old, you are single, you have, if you have parents that are still alive, put them as beneficiaries, at least on the application, right? Even when Jesus Christ passed away, he left his mother alive, right? But he's enjoying now in heaven. So on your life insurance policy, you are single, put your parents as beneficiary. By the time you get married, you have kids. It is only a paperwork that takes 10 minutes. Change your beneficiaries to your family. That is simple. So the benefit of setting up or buying a property, or trying to discover the best time to buy a house. People will say, when is the best time to buy? When is the mortgage interest very low so that they can plan to buy? Now you have to be prepared to buy. That is why you have to save and invest for your down payment. You have to be prepared to buy so that when the right time comes, you can just buy. Now people will say, okay, when is the mortgage interest low so that they can buy a mortgage and the interest that they are charged is not high. They are looking for the best time to buy or a house or a property. Now when it comes to life insurance, the best time to set up your life insurance is when you are young, when you are healthy, right? That is the best time to buy life insurance. Because by the time you are older, right, the day we all get closer to the last day. So by the time you are older, The cost of insuring you at 50, 55 is very expensive compared to when you were 25, 28, and you thought you don't need it. So because you are healthy, because you are young, your cost of insurance as a 20 or 25-year-old is going to be very, very affordable. So it's going to be very, very affordable. So there are some things you have to do for yourself, because the policy that you set up at age 30, the policy that you set up at age 28, you are going to need it in the future, right? Your life insurance policy, you can use it as mortgage life insurance. It doesn't pay off that mortgage when you are alive, but it makes sure that whatever is the outstanding balance is paid to the lender. So if your family receives the life insurance benefit and there's still an outstanding mortgage balance of, let's say, 500,000 or 400,000, they can easily pay off that mortgage and they live in a mortgage free house, right? Then they can use the remaining amount of tax free death benefit for other things, for investment. So even though your money cannot replace you when you pass away, you have actually made sure that your family do not suffer. What is the essence of having, you are a millionaire, you earn $200,000, and the day you pass away, your income is lost forever, and your family they start to beg for GoFundMe to do burial. Your family is struggling. Your partner has to do two, three jobs to actually be able to pay for that mortgage. What is your benefit? But when you were alive, you insured your car. When you were alive, you paid car insurance of 300, $400 for your car, because people can actually see the brand of car you're riding. You paid insurance for your house. People can actually see you bought a house. But your life insurance policy, people don't see it. It is only you that you know that you have a life insurance policy. But when life happens and you gain admission to heaven, the benefit goes to your family tax free. No noise, no crying. Well, money cannot replace us when we pass away, but that life insurance benefit makes sure that our family, they are financially protected, right? So they can concentrate on actually moving ahead with life. So a partner that loses their loved ones is not actually struggling to pay the bills, is not actually mentally traumatized, because combining the loss of a loved one and combining it with financial challenges is not that good. So let's go back to employer life insurance. Your employer offered you $160,000, which is two times your income. It is not enough. You bought a house of 800,000. You have children, you have three kids. You have a credit card debt of $20,000, and guess what? You need maybe 1.2 million based on this analysis. Your house is 800,000. You have three kids, like to support your children while going to school. That is minimum 50K per child, $100,000 per child. Can you see 800 plus 300? That is 1.1 million. Now you also did what? Your income. You want your income to be replaced if life happens to you today. So it's not about religion. You want your income. You earn $80,000, but if you pass away, you gain admission to heaven, unfortunately, right? You want your life insurance to be able to replace your income to your family for the next 10 or 20 years. So your life insurance should at least be 10 times your current income or 15 times your current income, right? Income replacement. So it means 80,000 times 10, that is 800,000. You have a house outstanding balance of 800,000, that is 1.6. Then you have credit card debt of $20,000. You have kids, three kids, for example. That means to support your kids, clothing, shelter, basic snacks to school, backpack, and all of that, lunch packs, all of that, throughout the time that they are going to, throughout the time that they are young till they turn 18, that is another $200,000 over 10 years, depending on the age of your children. So in total, we are talking about the fact that at least you need 1 million life insurance. If you have that 1 million life insurance and you pass away, $1 million goes to your family tax free. Now let's roll it over. You decided that you have an employer life insurance and you don't need your personal life insurance. Your employer gave you only $160,000, And if life truly happens, you gain admission to heaven, and $160,000 is paid to your family. How long will that money last? Maybe 6 months, maybe 1 year, and they are back to zero, no money. But you are in heaven, you are enjoying heaven. So what has happened to your family? So when we are talking about life insurance, the life insurance from your employer is good, but the fundamental fact is that it is not enough. The employer life insurance that you have is not enough. Now, if you work with that employer for a very long time, let's say you work with the employer for 20 years, 30 years, the day you retire or the day you retire, you don't have that employer life insurance because you are retired. They only offered you the employer life insurance because you work with them. The day you retire, you don't have it. And at that point, it is a huge regret. Oh, how I wish I had personal life insurance. But it is too late. You're already 60, you're already 65. The cost of insuring you as a 60-year-old is extremely expensive, very expensive. So what are you supposed to do now that you're young, right? Sometimes we might not understand why. So when you're young, 25, 30, you think you don't need it, but you need life insurance. Your personal life insurance, you can use it as your mortgage life insurance. Your personal life insurance, as if you choose to have a long-term life insurance at age 65. Let me tell you three things that your life insurance can do for you. One, it can pay you compassionate benefit of between 10,000 to $250,000. Yes, compassionate benefit. But you need to submit doctor's report that there is a terminal illness because that is the eligibility criteria. There is a terminal illness and the life expectancy is between 18 to 24 months, unfortunately. But imagine somebody is 75, 80 and they have a terminal illness. They still need money. That is the annoying part. This person that is terminally ill, that is already a senior citizen, still needs money. So you just need to send in your doctor's report to get that um, compassionate benefit between 10,000 to $250,000. And guess what? You can focus on getting better. At least that financial stress is out of the way, and then you can focus on getting better. I hope you understand the reason why you need life insurance now because there are some things you can enjoy from it in the future. There is also something that is called living benefit. God forbid, if there is a disability because of an injury or a sickness, right, or you have a critical illness, you can actually send in your doctor's report to the life insurance company and you can get that benefit. So if you're interested, I can help you understand the three different types of life insurance: term insurance, whole life, universal life. Don't allow a blind person to lead you. Don't allow a blind person to lead you. Now, if you can afford to buy a property, you are going to go ahead and buy a property. If somebody tells you that don't buy a property, keep on renting, are you going to listen to that person? Okay, it is your decision. Because if you rent, because that is what you can afford, that is fantastic. But if you can afford to buy a house and you truly, truly want to buy that house, you can actually buy it comfortably if you can afford it. This house that you bought over a period of time is going to start building equity over 10 years, 15 years. The equity that will be in that property could be 200,000, could be 300,000, and the equity on that house is useful to you when you are alive. But for those that are renting, they don't have equity to enjoy. They don't have the option of using their house as reverse mortgage to enjoy money tax free from the equity of their house. So that analogy is similar to having life insurance. If you have term insurance, it is very affordable, but it expires. You hear about $20 life insurance, $50 life insurance. Those type of life insurance is very, very affordable. But what they don't tell you that it expires. Let's say it expires at age 50. If you want to renew it at 50, at age 50 is extremely expensive. It could be like $600, $800 per month. Right? So people don't renew life insurance at age 50. Now the question is, do you actually need life insurance at age 65? Yes, it can support you with compassionate benefit, living benefit. If it is a policy that you have allowed it to accumulate cash value, if you have whole life or universal life, this cash value can support you financially, pay hospital bills, pay medication, support you at that age when you are a citizen, a senior citizen, that is, you are already advanced in age. This type of policy can support you. So, your employer life insurance is valuable, right? It is very, very affordable because of the group rates, right? Because it's like 5,000 people get group employer life insurance from their employer. So, because it's a group, the cost of insuring them is lower, right? But the coverage that you have from your employer life insurance is not enough. Is not enough. The employer life insurance is not enough. Like I give a simple example. You earn $80,000 per year. Fine. Your employer gave you two times your annual salary, which is $160,000. Is it enough? You're someone you earn $150,000 per year, and your employer gave you 200,000 or 300,000 life insurance. You have a property, 800. You have kids, you have family. Let's assume life happens, and your employer life insurance pays your family $200,000 tax free. The issue is how long will it last? Will it last for 1 year or 2 years? So after 2 years, it is back to zero. So your life insurance policy should at least be able to replace your income for the next 10 years, or for the next 20 years, or for the next 30 years, depending on your situation, depending on your age group. Your life insurance should be able to replace your income for the next 10 years, for the next 20 years. So when you are not even able to support your family, your life insurance is able to financially support your family, right? That is the benefit of having your personal life insurance. Like I said, let's assume now you work with a company for like 30 years. The day you retire, you don't have that uh, benefit from your employer. You have lost it because you have resigned. Now you have resigned, you are 60, 65. You don't have life insurance. It is even expensive at that age to get life insurance. So there are so many things you are going to spend money on. So many things. And some of these things are not going to be useful to you in the future. So many things. There are sometimes you're going to buy shoes, you wear it one, two, three, four, 5 times, and afterwards you throw it away. There are some things you have bought, you have hoarded it, you are not using it. But you see, your life insurance policy is something that you are still going to use. So life insurance is not about I don't believe in life insurance. Do you believe in car insurance? Do you believe in car insurance? But why do you have car insurance? Because it's compulsory. So you don't have car insurance because you don't believe car insurance. You have car insurance because you know it could happen. You are a good driver, but somebody can hit you. How will you make sure that you are protected? How will you be able to pay 3,000, 4,000 out of pocket to actually fix your car, right? Okay, so employer life insurance is good. It is not enough. That is it. The day you retire, you are you may be able to convert the group employer life insurance to your personal one, and it comes at a more higher rate, because before it was a group plan and now you are converting it to a personal individual plan, so the rate is going to be higher. Okay, so another thing you have to take note of is, let's say you are 30, 28. The reason why you need your life insurance now is because you are young and it is very affordable. By the time you procrastinate to the next 2, 3, 5 years and you realize that you need it, it's already more expensive. So the more you procrastinate about life insurance, the more expensive it gets. So your personal life insurance is useful to you when you are alive. It can support you with compassionate benefits, living benefits, depending on the policy that you have. It can also help you. You can use it as your mortgage life insurance, which is something that I like to talk about. So I don't know if you currently have a mortgage from a lender, right? Mortgage life insurance, they would have offered you at some point. Mortgage life insurance means during the amortization period, let's say 30 years or 25 years, you will still owe the lender. So let's say the mortgage plus interest, it's a total of 800. Now, during that 25 years, you are going to be paying back a certain amount of money every month. Let's say 35. So the lender will be like, see, we have borrowed you 800,000. For the next 25 years, you are going to be owing me a certain amount of money. How can I get my money? back if you were to pass away. So mortgage life insurance, the benefit is paid to the lender. It doesn't come to you. It doesn't come to your children or your family. The benefit goes to the lender. Mortgage life insurance means your life is insured during the amortization period, and if life happens, you get admission to heaven. The what you owe on that mortgage, the outstanding mortgage balance, is paid to the lender. So the lender has protected themselves. So your family is definitely going to live in a mortgage-free house, but they need money to maintain, they need money to pay other bills. But you were the one that decided to have mortgage life insurance to protect the lender. But you can have your personal life insurance and use it as your mortgage life insurance. So you know there is a proverb that says, put the horse before the cart. Don't put the cart before the horse. So even before you buy a house, you can set up life insurance because your life is even more valuable than a house. It is someone that is living in a house, it's someone that is alive that can live in a house. If you actually know that your life is valuable, right? And life lost will not come back again. It's lost forever. Or your car is replaceable, your house is replaceable. So setting up your life insurance of at least 1 million, 1.5 million is a good way because that benefit goes to your family tax free. So let me know if you have learned something, the difference between your personal life insurance and your employer life insurance. Your employer life insurance was offered you because you work with that company. The day you resign because you got a better job, you lose the group benefit. You can convert it to a personal one, but it could come at a higher cost. Now, another thing you need to know about employer life insurance is that the coverage is not enough. You earn $80,000 per year, your employer gave you two times your annual salary, 160,000. So in case life happens today, it is 160,000 that goes to your family through your employer life insurance. Is that enough for your family? Or would you like 1 million to actually go to your family? Because you earn 80,000 and you want your life insurance to at least replace your income for the next 10 years, for the next 20 years. So can you see that your employer life insurance is not enough? If you want your life insurance to replace your income for the next 10 or 20 years, it means 80,000 times 20. Can you see the value? That is the value. You at least need 1.6 million life insurance. So when you are young is the best time to set up life insurance because it is very affordable when we are young. As soon as a child is 2 weeks old, 14 days, parents can have life insurance for their children. Not because the child is going to pass away, but it is the best time to get affordable life insurance so the child can enjoy cheap and affordable life insurance. So if you're 25, 30, you're working, you see no priority, it is not your priority to actually have life insurance. What you need to know is that at age 25, you are very young, so the cost of your life insurance is very, very affordable, right? Very affordable. So you set up your life insurance because you want to do it at the time where it is affordable. So the question is, when do you want to buy a house? You want to buy a house when it is uh, the interest on the mortgage is low, right? People ask these questions. When is the best time to buy a mortgage? I'm planning to buy a mortgage. Is it in July? Is it in December? Why are people doing that? They want to buy that property when the interest is low. So the time to buy life insurance is also when you are young, when the cost of your life insurance is low. Because when you procrastinate by 5 years, you're already 5 years older. To insure you in the next 5 years is also going to be it's more expensive because you are 5 years older. I hope this helps you to decide. So reach out if you have questions. Reach out if you want to set up your policy. My name again is Yemi Silibushe. Thank you so much for having me.